Cutler YMX uses the Netrodyne two-way camera system in all of our power units. The Netrodyne cameras have more than once exonerated a driver who was perceived to be at fault, as well as saved our Cutler YMX from paying damages related to an accident. We are already seeing, just in 1 year of Netrodyne, the impact of better safety scores and fewer damages and incidents in our insurance rates.
Here we are.
It's Thursday again.
Thursday, August 1st, for those of you watching live at noon. Starting August. Zach Strickland, Head of Market Intelligence.
Tony Mulvey, Senior Analyst.
Here to bring you the freight market, transportation market,
Yeah.
and economic news that you need.
It's been a busy week if you look at the data, and we'll get into it in the market too, kind of boring. Not a whole lot of changing activity per se, but it's earnings season, so there's plenty to talk about from that perspective, just of what's changed, what's management saying, things like that. That's quite interesting.
I think the data supports a lot of what they're saying too, which we'll get into here in a minute. But I there's always degrees, when you talk about things on different timelines, and people are like, well, you beat expectations. Well, what were those expectations?
Yeah.
Like there's relative views and things like that really distort, the reality. And I think the data helps us bring that into context quicker.
Yeah.
I mean, the Tinder Rejection Index, my favorite thing to look at right now, tells us that the market itself isn't necessarily like on fire, but directionally speaking,
better than it was.
It's moving to a tighter, more balanced environment.
Yeah.
We still don't know what that inflection point looks like. Are we still in store for a huge flip, or is it just going to slowly go into
just become a tighter market, right? Like in 20, I look at COVID, right? Like that was a very quick change of the market direction. We've been in this period where it's been like trending this way for 4 quarters now, really. Like you call second quarter of last year the true bottom in rejection rates, and we've been moving kind of sequentially higher, albeit very small. And
we keep hearing the term green shoots from these earnings calls. They keep showing up in these carrier calls, and green shoots to a carrier is not necessarily so green to a shipper. Need to keep that in mind. But this, we're having this situation where everybody's kind of hoping for things to kind of get more positive for them. Well, one person's gain could be another's loss.
Yep.
In the CPG sector specifically, we talked about this. They're not seeing green shoots in their line of work, which may inhibit the green shoots that we're seeing in the freight market.
Absolutely. Well, Zach, we're sponsored again in August. Thank you, Netrodyne. So remove the guesswork from driver management and fleet safety and start predicting your accident reduction cost savings. Netrodyne's AI-enabled video safety platform corrects unsafe driving habits, recognizing and reinforcing great driving. With the Green Zone score, your fleet of engaged drivers will protect your bottom line. Every 50 points earned is a 14% to your cut to your accident rate.
And we talked to Adam last week, Khan, Chief Strategy Officer at Netrodyne. Great discussion there. Knight Swift's earnings were impacted by an accident, a big claim, liability issue, 6 cent hit to it. And I mean, that to me, like that whole, the barriers to entry in trucking have been minimal. And I think this, insurance and liability, has become an increasing factor in that barrier to entry.
Oh, it absolutely is. It's one of those costs that's going up, and it's typically a hidden cost, especially like you think of insurance premiums, what you're paying every month is not a hidden cost, right? But the risk that you run if you have an accident where the insurance claim goes, oh, we're only going to cover this, and these attorneys have gotten very good at getting more money than what insurance will pay out.
Anybody thinking to enter the space needs to keep that in mind, because especially right now, if you're looking at the O-Tri, it's not the right time to jump into this market either. So
Absolutely not. But Zach, I think that gives a great lead in for you to deliver your market in 2. So I'll count you in 3, 2, 1.
let's go. Outbound Tinder Rejection Index. Pretty decent peak July 4th. We're coming down off of. We're still outperforming that 2019 line, but it's still historically low. Keep that in mind as we're talking about this. Directionally speaking, things have gotten tighter, but only marginally. We're still just above 4%, which anything below 5% is a deflationary rate environment in general. We're still seeing contract rates fall. We're down about 2% year over year in our contract invoice rate index that we have here. So there's still just too much supply out there, even though we are seeing increasing vulnerability. The July 4th outperformed last year by a good clip. We got over 6% for the first time in several years there, but it's still a very loose environment. Let's move on to the next one. Outbound Tinder Volume Index. From a demand standpoint, a little misleading here. So demand, of course, down significantly versus the pandemic era. We're nowhere close to that level of demand, but we're up about 4% year over year. Now, the kicker to this is that actually, if you accounted for average length of haul, we're about flat year over year, because short haul freight, local freight, less than 100 miles has become an increasing percentage of this freight. A lot of this upstream demand. We talked about this with Dr. Zach Rogers a couple of weeks ago about what's going on here. Let's go to the next one. Talk about some spot rates. RTI sitting there on top, our refrigerated truckload index, measuring the average aggregated spot rate across the United States for refrigerated trucking, moving higher. And this is an interesting thing, the refrigerated section, and you see the dry van NTI down there on the bottom. This is kind of holding steady, and this is a healthier, sustainable increase in the refrigerated sector. We'll see if it holds true as we hit the third, fourth quarter, which is actually where we see things pick up. Let's go to the last chart real fast and look at Los Angeles to Chicago rates. Perking up over contract rates on the refrigerated side of things. And this is the scenario, as we close out the market in 2, this is the scenario that everybody needs to be aware of. Mm-hmm. If you are out there trying to source capacity, if we pull this chart back up one more time, you see the green line, that is the spot rate in our market dashboard tool. You see the purple line, that is the contract rate. Yeah. This is the exact scenario a shipper does not want to have happen.
Yeah, that's where your transportation budget gets squeezed.
Tender rejection rates shot up to 12% right when those two crossed.
Yeah. Yeah, it's not a surprise. I think the interesting thing is, like, you start, and this is going into Chicago, right? Like, this isn't going into, we talked about it a few weeks ago, LA to Denver, right? And saw similar, you saw similar trend happening, right? Spot above contract. You don't see it going into Chicago or going into Dallas, right? But this is a early sign that, again, the market is changing. And you have to be ready for it. I mean, I looked at it. If you look at Ontario, tender rejection rates have held above 6%. Mm-hmm. It's not normal that they're above the national average.
No.
So to me, it kind of signals that we're headed to this tighter market. Mm-hmm. It's just a matter of where it's going to be and when. And I think that's the hardest part to kind of judge. But it's definitely heading that direction. I mean, it sets the fourth quarter up to be arguably much tighter than it is now. I mean, you could see rejection rates get on a national level up to that 4, 5, 6. Well, it's already above. It's at 4.5, 5, 6, 7%. I mean, before you get to the holidays, and then you look at 2018. I mean, we peaked out at what, 14%?
Yeah.
So I think those numbers come into play rather quickly when you start looking at markets like in Ontario, LA, where you're having rejection rates, up 150 basis points above the national average.
Well, the refrigerated market, of course, a little bit more volatile than the dry van market. And when I was talking about 12% rejection rates, I was talking about refrigerated. Yeah. And of course, much more volume moves on the spot market in the refrigerated sector than the dry van. But this is still an example of the market conditions that are very like this is a leading edge
Yeah.
of a market flip. This is what we normally see. These markets that are showing up, it's not happening everywhere. It's happening in Los Angeles, Southern California market, which has been having increasing pressure because all the import volume and things going into there.
Yeah.
And we've had produce season kind of not really be this huge explosive thing, but it's been sustained over a period of time.
Well, and you talked about it last year, right? Pacific Northwest, looking for that thing to like the capacity footing to like break. And it's like you start seeing it in LA, 12%. I mean, you look at rejection rates, again, 12% rates, spot rates going up on the reefer side. Like it leaves areas like the Pacific Northwest exposed.
Oh, totally.
Especially as we get later. I mean, you start getting into apple season, then you get into Christmas trees. So it's like you have like two things like back to back up in that area that can impact reefer demand.
September, top season.
Yeah. So I mean, you're getting into that time frame where an area like the Pacific Northwest could be extremely exposed.
And it's normally oversupplied.
Yeah.
And they just don't have consistent enough volume to have enough carriers paying attention.
Yeah.
Typically, I mean, we're still in an oversupplied market. Typically, the market does adjust.
Yeah.
You know, if that rejection rate nationally is below 5%, there's plenty of capacity. It's just a matter of are they in the right places?
Yes.
And when you're talking about certain segments of the country that don't have enough, it draws that balance.
Yeah.
It happened with Atlanta. Atlanta didn't have a demand spike earlier in the summer. It was that Ontario did. Yeah. And that Southern California volume has been relatively sustained throughout. Well, let's move on to the economic situation here because we talked about green shoots. I just showed you one technically in the truckload market with the refrigerator rate, but let's talk about the economy a little bit here. Lead us in with jobless claims.
Yeah, so jobless claims this morning came in at 249,000 above expectations of 235. So pretty big miss. I mean, higher than expectations. I think you had the Fed yesterday keep interest rates stable again. Not really a surprise given the timing. I think what was more interesting out of that is they kind of hinted that a September cut was possible, but they didn't come out and say like, hey, like we still need, they basically came out and said, we still need to see continued improvements to inflation. I think to me, that's where that green shoot from a truckload perspective kind of, I don't want to say waivers, but it's like if we would have gotten a lot clearer picture of like, hey, an interest rate cut is on the horizon near term, like I think it kind of would serve as a boost to some of the industrial side of the economy that it's kind of lagged behind. And why it's lagged behind, I mean, you look at the PMI, the manufacturing PMI that came out this morning as well, being down 1.7 points month over month to 46.8. It's like the 7th consecutive month of contraction. 20 of the last 21, I think, have been an overall contraction. But then you look further upstream, new orders, further into contraction, 47.4, down 1.9 points month over month. I mean, that to me is that those two, like three things combined, right? Some faulty, or not faulty, but like the jobless market or job labor market's like clearly not as tight as it was. Like there's some cracks showing there. You have manufacturing slowing down from where it was a month ago, and then you have the Fed holding interest rates steady for another.
So I want you to lump CPG's outlook into this, some of the earnings that we've had here, and then I want to respond in bulk.
Yeah, I mean, I think you start looking CPG. I'll talk to it from a call it quick service restaurant. I think that's probably the place I've looked more recent, just because there's been drives and initiatives placed to drive stores or same store sales. You look at McDonald's driving a $5 value meal. I mean, you had comp sales down in North America about almost 1%, just shy of 1%. Then you had Starbucks down. I think it was 6 comp sales in North America, down 6% year over year. So, I mean, consumers are clearly seeking some value and willing not to go spend money in places. And I think that's the other side, is that the consumer is more value driven right now than they have been, call it the last, well, I mean, you're talking since the pandemic when we saw this boom.
Well, and also anybody interested in more about the CPG sector, the Stock Out, hosted by Grace
exactly.
Sharkey and Mike Bowdendistel. Be sure to check that out as they cover it very well and in much more detail than we do here. But so here's my thoughts, Tony. We've got, jobless claims. Historically, they're still not high. Like we're talking about 249. I think, Anthony Smith used to talk about 275 to 300K being where we start to get concerned, and we're at 249. The PMI, the industrial sector, nothing new here in terms of contraction, and the new orders component for sure not super great, but at the same time, I think this sector has been poised. It almost feels like a coiled up spring that they're loading, and they're waiting for these interest rate cuts
Absolutely.
to really pounce on some of these orders, which potentially could drive a pretty strong surge. And especially it's an election year, and I hate politics and I don't want to talk about it, but it does have an influence on a lot of companies' decision processes.
Yes.
So from my perspective, all of this stuff kind of packages really nicely into a nice little interest rate cut later in the year, and the industrial sector finally gets going. We've talked about upstream orders a whole lot. Again, Dr. Zach Rogers and I had a discussion about this on our show, where this upstream, the short haul freight that I mentioned briefly, a lot of that's upstream industrial raw material stuff. This time of year, that is exactly what it is. It's less retail fulfillment, although we just had Amazon Prime Day, which fulfillment is short haul freight as well. So we did have Christmas in July a little bit with those out reports. So I'm not overly concerned here with some of these economic figures being less than stellar. I think they actually help paint a picture downstream that this fall and winter could be better.
Yeah, and then I think the other side is like you look at spending trends, and like Bank of America's card spending report was fairly weak. I mean, retail ex auto for the most recent week down 1.1% year over year. But it's things like entertainment, furniture, home improvement, things that have been drags overall are continuing to drag on overall spending. So I think that's a trend you'll continue to see.
Well, people overspent on those things during the pandemic, and they don't really have a need for them right now.
Correct.
So let's move on into some of these earnings reports and the news reports that we've had. I think there's a lot of big takeaways here. We talked about green shoots. Well, C.H. Robinson, first look Q2 numbers up from both Q1 and 2023. And this is a revenue, but also profit number. So like we've been talking about revenue deterioration on just about everybody being down. But they actually expanded their margins. And I think that is a pretty decent situation, except for the air. The air was the only one that was down significantly. Their global forwarding should not be a shock to anybody that watches our show or has Sonar or anything. Global forwarding being probably the second most robust environment from a sourcing standpoint than we have versus the pandemic. So that should be no shock. But what shocked me more is the global transportation, or the North American surface transportation
margins expanded, which that doesn't surprise me as much. I think it's what did, and you can see it right here in the chart, like it's been trending higher for a few quarters now. So like the margin expansion, I'm not going to take a bit, like it was a good sign because it got back to a level like that is kind of more in closer to those historical numbers that C.H. Robinson had. I think the key takeaways I had were they grew NAST volume by 1.5% year over year. I mean, we've talked about volumes being up year over year for quite some time, and you don't necessarily see it like at the truckload carrier side. We haven't seen like volume growth. We see it now here at a brokerage, which is kind of an indication like we've said, volume's there and it's grown, but it's just not being felt by everyone. Well, they're showing it. But then you factor in that they reduced headcount by 10% year over year. So they're become, again, and they'll highlight it, and they've talked about it. They've become more efficient in their buying, right? And selling their services. I mean, you grow volume and reduce headcount. I mean, that to me is pretty solid evidence.
But still, normally you don't see margins expand when you have spot rates increasing underneath contract in this world. And so that to me is a sign that they do have something working for them outside of other market conditions.
I mean, to me, it was a really, I mean, good quarter, all things considered, where you thought that maybe this would have been the time where contract rates were darn near their lowest, and you have seen some slight spot rate increase, and it just didn't necessarily have that impact.
Yeah. So let's move on to Knight-Swift purchasing DHE as next piece of national LTL map. I don't think this is a shock by any means, but I kind of want to use this as kind of a lever to talk a little bit about the LTL market in general. Why is this a good situation? I mean, Knight-Swift has absorbed LTL.
It's been fantastic.
Fantastically well. The synergy here looks to be working well. It's very rare. It's not simply that you can just add on. LTL is as different from truckload as parcel is from LTL. It is a very different animal. And it appears that they're letting the LTL AAA Cooper just do their thing.
Yeah. Which is
underneath
the smart
their
thing
umbrella.
to do.
And then they're feeding each other. In terms of being able to just be the single source solution for people from an LTL and truckload environment, it looks like that's working extremely well.
Everything, right?
Yeah.
Because they have the intermodal component. They have the brokerage component for, say, excess volumes, right? So to me, it makes more sense. And you looked at where they had made acquisitions in the past, right? AAA Cooper in the kind of South. They've been in the Midwest. They'd been missing kind of that West Coast, Western half of the U.S. touch point. And that's where...
Yeah, this is a geographical piece, and this is how you grow an LTL network responsibly. You purchase pieces in these little regional sections, and they're doing that well. I want to pull up this chart to talk about the LTL market and the truckload market. This is why Knight-Swift, I think, not this one specifically, that's their LTL earnings, which you can see clearly they're doing something right. No, the one you had before, guys. There you go. That's the one. So this is an overlay of LTL contract rates, average revenue per hundredweight. It's pretty messy, noisy. That white line, you can see a lot of volatility there, but that's because of the nature of revenue per hundredweight. And then on top of that is the van contract rate average. So this is why having LTL as part of Knight-Swift's business is so good, because you can see the truckload market moves so quickly. The LTL contract rates are very sticky. They are not, the truckload contract rates, not nearly as sticky as the LTL market is, although the LTL market feels the same pressure that the truckload market environment feels at times. It just doesn't respond as quickly. So having this is kind of a hedge to the truckload market. The contract rates for truckload plummet. LTL market was starting to feel this, and then Yellow exited. So they did get a bit of a boost here. And then I want to pull up this one chart, the white one with the orange and blue lines there, if we can pull that one up. Okay, so we have some data here. This is a diffusion index for LTL pricing over the last 5 years. You see how quickly that orange line and blue line drop in 2022? Well, it doesn't show up for LTL carriers. This is how quickly their pricing changes are. So they were quarter over quarter change in third quarter of 2022. They were offering cheaper rates than they did in the quarter before. Significantly cheaper. And then they held that rate of deterioration all the way in until Yellow exited in the middle of 2023. And then they were able to get a boost again. So this helps me segue into XPO, who reported carrier beats expectations. So keep that chart in mind. So they beat expectations, but they beat expectations off of a pretty weak Q2 right before Yellow exited last year.
Yeah, and I think that's been my takeaway from the LTL. Most of the LTL earnings reports have been quite solid. Now, to that, I mean, I do think there's maybe more barriers to entry from an LTL perspective than the truckload perspective that have helped keep that kind of pricing a little more sticky, which is why it makes all the more sense. You basically add a revenue source that's a little more stable.
Well, they grew revenue. Their revenue was up 12%. Their tonnage per day was up. So they grew some volume, but again, Yellow exited. So this is going to give them a boost year over year because a lot of these carriers absorbed some of this. They also got a pricing boost. From that. You saw the pricing conditions were actually favorable, and the pricing conditions in Q2 of last year were not good. The pricing comps for this year, much better, and it takes a whole year to flush this out. So again, XPO is a fantastic LTL carrier. They had to execute, and they did well. And I'm not trying to discount that by any means, but their environment definitely gave them a little bit of a boost.
Yeah, I think from the LTL perspective, I think looking into Q3 and Q4 and how they operate versus those comps, because that's really when the problem, the hard part is it may take another year to really see how well they do. Because, I mean, even when Yellow exited, like, and that freight had to be repriced, like, it didn't flow immediately into, like, some of it did flow into LTL carriers, so they wanted the volume.
Yeah.
But then the repricing's happening over the course of this year.
Yeah.
Right. So it's like, how do these comps really weigh? Like, it may be another year before it's like, all right, Yellow's completely out of the picture. All of that freight has been repriced. Like, how are things trending now versus, against right now? The conversation we're having right now against kind of easier or weaker
earnings
comps.
are so slow to actually reflect things, but they are good indicators of where companies are at. Now, you saw at the end of that white chart that I had up there that pricing conditions actually have deteriorated since the 2020, the middle of last year.
Yeah.
And that's because the Yellow exit created a little bit of a bump, and then things have kind of fallen off. So we'll see if that materializes 12 months from now.
Yeah. I mean, again, that's what we're looking for is the 12-month. We've got another year before we're having this exact conversation on the pricing element. But I mean, all things considered, the LTL carriers have had pretty standout quarters relative to what expectations were.
Execute regardless.
Yeah, exactly.
All right. Well, that'll do it for this week. Enjoy the Olympics. Have a great week.